quantitative strategist at ITG, and he's worked for a couple of the largest hedge funds in the world, Everest and Elliott, I guess it's Associates, Elliott Management, and Rich Gula has been on many of these calls and is a great friend also, going back to the Brimberg days, going back a couple decades. And he worked with Dean LeBaron, who's on here, along with Ned Johnson, to Boston investment management icons. And Rich set up the chart room over at Fidelity, and he's a quantitative analyst, and he advises a bunch of fund managers over at Fidelity. What we're going to talk about is the changing environment. I call it the great rotation. Gold, oil, inflation, interest rates are all rising. And really, as a CFA, they teach you to try to think analytically as it relates to financial markets and asset values. And one of the things that strikes me is there's something called a fundamental factor. And one of those is interest rates. Another one is inflation. And when I went to school, I went to Duke, I graduated in '83. We went through a very difficult period right before that. That was the Volcker period, where you had high inflation and high interest rates, and it was god awful. And from that point on, once they finally started to turn things around and inflation went down and interest rates went down, investing in financial assets was it was a great party. One of the things that in particular I find is important when you kind of step back, I'm a big fan of Robert Shiller, and he wrote Irrational Exuberance, is it's very helpful to think of markets over long periods of time. And what struck me with his work was it was going back to like 1870. Now, this particular chart shows the balance between the ratio of the S&P divided by the PPI. And what it does is it very clearly shows 10 and 20-year periods where we either were in a deflationary or an inflationary environment. And what that means, everyone remembers inflation from the 70s. And what happened is stocks did terribly, but actually gold and oil made some people billionaires. But from 1982 to 2000 or 1999, if you were in stocks, that was the place to be. But being in oil and gold, natural resources, didn't make any sense. But then again, you flipped in about 1999, 2000 to a inflationary environment. And in that environment, suddenly gold did very well, oil did very well, commodities did well, but the S&P had two meaningful declines, and being in the S&P 500 made no sense. So, you go to wherever you go, maybe, depending on who you are. If you go to a financial planner, they'll say, oh, you want to be 60-40 and you want to be in the S&P 500. And I think that thinking is problematic. I actually had the pleasure of meeting Dean LeBaron, I think in Lyford Key or some wonderful place down in Florida. And I remember talking to him, and he said, the S&P in my mind is one of the best shorts. It's just so heavily overowned. And I think that the nature of where we are today, that case can be made very, very compellingly. Everybody owns it. It's what all the financial planners tell you, 60%, equities. And if you don't know any better, let's just put it in the S&P and, the rest in bonds. And I think that thinking is completely wrong. But where it's wrong, I think, relates to this inflationary cycle phenomenon. And I think that we have entered it. We have higher interest rates, and inflation has moved up meaningfully. And I think it's going to continue. So inflation hurts. So what we saw inflation go from 1.4% in 2021 to 9.1%. The Fed said inflation is going to go back down to 2%. What I learned in economics is you need it. What's going to drive it? And, you need more production. And we're not having, more production if you're shutting down oil. And oil prices have gone up. And if you're regulating, these things are problems. If you've got too many dollars chasing too few goods, all these things have not gone away We're not in a situation of overcapacity. So I'm very questioning whether or not we see the CPI, the PCE continue to decline. And I think that represents a risk. And I think that that's what's driving the great rotation. I think one of the best ways to look at the market is that you don't look at stocks just in and of themselves, but you want to look at it relative to their comparable to alternative investment assets. And so you want to look at it, let's say, compared to the 10-year US Treasury. And what the Fed model does is it says the earnings yield on the market. What is the yield? How much earnings are produced by the S&P 500? And you compare that to the 10-year Treasury. So the earnings yield down here versus the 10-year Treasury, those two are almost equal. Last time they were when bonds got actually over the earnings yield of the S&P, the Nasdaq went down 83% and the S&P went down 52%, and that was a great bubble in 2000. We're almost at that point, so I don't see at this juncture a compelling case to be heavily into bonds or stocks. I'm not saying they're terrible, and I'm not saying that they're not going to continue to do well. But I think that, right now it is a much riskier proposition. Another way to look at it is the Buffett indicator, which compares the value of the Wilshire 5000 to the GDP. And it's expensive. It's near peak valuation. So again, I'm not keen on this on stocks. Looking at the Shiller ratio, we've got a 34 PE. That's on a 10-year basis, and that's very high. Now, there was a point where you could argue that the PE on a Shiller basis could be at all-time highs, and that was because interest rates since 1981 went from 15.5% all the way down to 0.5%. So when you weren't getting much competition from bonds, well, then you can allow for a higher PE. Well, now we're looking at near a historic PE on the Shiller CAPE ratio, but now you're getting interest rates moving up. And my concern is actually interest rates and inflation will continue to trend higher. And so that's what the problem is. All the conventional thinking, let's go 60-40 and buy bonds and buy the S&P and we'll be fine because that's what worked well, buys you into a psychological phenomenon known as recency bias. People tend to only remember the last 6 years, and I think, or the recent history, or they use historic returns as the basis for making predictions about future returns. But arguably, if you're a practitioner of investment analysis, you want to buy things that are cheap. You don't want to buy, what were the great winners of the last 10 or 20 or 40 years. And I think that that's precisely where we are. So, Walter Harrison, thank you for joining us.
My pleasure, Tyson.
So here's where we've seen some weakness in the market, and it's because the 10-year US Treasury, keeps on pushing higher, a 4.65% yield. Well, that's starting to be competition, and certainly relative to where we were in, I think, August of 2020 when we were at 0.5%. Yields have moved up a fair amount, and suddenly, actually, you have some competition for the S&P 500. There's some other problems. I mean, we got 32 trillion, maybe it's even 33 trillion in debt. And not only that, the cost of that debt is going up. And now, because interest rates are going higher, financing that deficit is over $1 trillion a year. It's more than what we spend on the military, and that's staggering. I like to look at this ratio. I don't have it marked up as I often do, but if you look at the Goldman Sachs Commodity Index versus the S&P 500, and you look at that ratio, you get these trending moves. From 1999 to 2008, it was trending up, and that was the time to be in commodities. And basically from that point or this point here, this ratio was trending downward, and it bottomed in 2020, and that was the time to be in equities. What I think is happening now is, again, you want to fade the equities and get more into commodities. And I think you actually had a tremendous run between March of 2020 and, let's say, mid 2022, after Russia invaded the Ukraine. Natural gas prices went way up. You made a lot of money by buying energy stocks, but natural gas producers started drilling and natural gas prices have come down from 10 to 2. But I think that that is starting to turn up, and next month I'll have an updated chart, and I think that that's going to move higher. Now, I think another major driver in energy is something that transcends the economy. So inflation in it, spreads elsewhere. And, we have a variety of problems that would suggest that oil can go a lot higher than $85. I'm not saying it's going to 150, certainly 100. I think I read something that said the Saudis might start selling a little bit more oil if it starts going up over 100, maybe 115. I forget what the quote was. But, the problem is there has been an underinvestment in energy, so they haven't been spending it. So the amount of resources are limited. Uh, it was booming for a while. Under the new administration, they've really kind of shut down the drilling that was going on. We've had a big push towards renewables and ESG, and all that seemed to kind of take the bull market out of oil. But since 2020, when oil was trading at negative rates, um, it has rebounded. The economy is strong. And we also have geopolitical tensions, and that makes the price of oil and other commodities go up. Iran, Israel, Russia invading Ukraine, these Iraqi, Iranian proxies, these are all problems. Another area that I think makes sense that's consistent with a inflationary cycle favoring commodities is gold. Gold makes all the sense in the world to me. Never been a big investor in it per se. I've written about it, have bought it for some clients, and actually done that fairly well in recent years. And this chart is breaking out. And I think that the upside here could be quite significant. And so do we go to 3,500? I'm not sure. For all I know, we could go to 5,000. But the point is, we have inflation and stocks and bonds are overvalued. There's a lot of money. There is geopolitical risks. There are reasons for concern. We have inflation. And a lot of people like Bitcoin. I don't understand it well enough to feel comfortable getting into it. But gold's been around for a while. People know what it is. And I think that that is a place where putting a decent amount of money makes a lot of sense. Historically, you had a big move in gold and silver stocks in the late 80s. And you also had it in that 2000 to 2008 period. And I think we're in a period again where these are going to take off. I think that I just want to kind of have a throwback to history. Uh, some people on this call may remember this era better, but in 1981, the S&P traded at a 7.83 PE on $15 a share, and it had a 5.4% dividend, and the yield on the US Treasury was 15.15%. Now, you tell me that I should put a pension plan into 60% the S&P 500, 40% 10-year US Treasuries, and I'm getting 40% is going to give me a 15% yield, and the rest I'm buying stocks at a 7 PE with a 5% dividend. I think that that's brilliant. Problem is we're looking at the flip side of that. I'm not sure whether you can see it, but the 60/40 has just had a huge run. It's almost parabolic, and I'm just suspicious of it. I don't think that we necessarily will have a crash. I think that the mega caps may fade here. I think the market's going to broaden out. I think money is going to go elsewhere. What I'm advising is that generally a 25% cash, 25% commodity, 25% stock, 25% bond type allocation is where people should be thinking. because the backdrop of 4 decades of declining interest rates has ended. So this is me. We have a new speaker, Mitch, you'll want to unmute. He is Mitch Bulajic. He was an advisor to a hedge fund I ran several years ago. He was a quantitative strategist at ITG and worked at Elliott Management and Everest Capital, and is working now between Miami and London, and he's working in the AI space, and he continues to track the markets. So, Mitch, just tell me when you want me to. I'll just flip through
Sure. Yeah.
through the slides. Just tell me when to click.
Okay, fine. Thanks. And yeah, I'm literally between London and Miami, in the middle of the Atlantic now on a cruise liner. So it's very figurative. Can you hear me well, first of all?
Yes.
Yeah.
Okay, good. All right, I'm going to do a two-part now. One is really a macro view of the AI factor or phenomena in the marketplace, just through quick slides and comments. And then I'm going to take a little micro look from the point of corporations, what the corporations need to be doing and what are we actually surveilling if they're doing to really evaluate them. Are they catching on or not to this trend? So let me just start with this. Buying dip fours are fading. This came from Bank of America, very good analysis, is to keep in mind, buying the dips has actually first time that it's faded since the AI phenomenon. What does this mean? It means potentially is the AI story already built in? Is it fading away? I would say yes, definitely. Can you go to the next slide? I'm going to be very quick, but if anyone has any specific questions, stop me. Speaking of the fading of the big AI, let's look at the Mag 6. This is very systematic because now we had the big six outpacing. And now if you look at the forward earnings, which are actually in blue versus the brown, which is like trailing earnings, we have a flip side. Rest of the tech, which is the big six tech. So the fact that they're pretty much in a range now weakening is something that probably could prevail. So another negative thing going on in the market.
So you're telling me they're at 15 times forward earnings right now, the big six, which is like Nvidia and Amazon and
yeah.
Well, 15.5 isn't that expensive.
No, but it's something to keep in mind. That's
okay. So and actually the rest of tech you're showing at 25. That's not so cheap.
Yeah, exactly. Go to the next slide. Okay, here's the one long-term to keep in mind. We're talking about AI and productivity. And if you look at this chart, this is very symptomatic. We actually have flat productivity since the 2000. That has been slowly inching up. And generally, if we do have this AI productivity phenomenon, which we will have, there's no question about it, then chances are we will be breaking into the new highs. And then it's going to be a big question looking at long term. How does the productivity really fare? How much of productivity we will have, improvement, and what the inflation is going to be. So this is something to watch. So what this is telling us that eventually, yeah, AI is real. It will impact dramatically the productivity, and we could be having a trend on the breakup of this chart since 86 to 2000. We might be having the same trend on the upside. Can you go to the next chart?
You see it?
Yeah. Okay, this is if we look at just discussing AI, this is not stocks that have proven that have implemented it, understand, implemented, and have actually benefit from AI. This is just a lot of talk. And how much talk has actually lifted the stocks? Of course, good part in this is the mega sixes as well, versus the tech sector and the S&P 500. So what this is telling us, expectations are tremendous. And they're slowly coming to, I'm not saying the trend is reversing, but we're coming to a phase of really show me the money. We're really trying to see how companies can actually get into this, and how realistic and how fast can they get into this profitability trend? You want to go next? Yeah, one thing to watch, especially with the Mega Six, is as they call them, the hyperscalers. They're expected to be a major dominant force in capex going forward, and basically they have been so far, and that trend is going to continue. So I think one of the big movers on the upside is going to be the capex of the Mega Six, which we have to watch very closely. Next. Okay, now you talked about energy, Tyson. This is kind of a little thought on the energy part. We heard a lot of comments. How are we going to transition to EV vehicles without the power source? In other words, you would need twice as more power plants to power all the electric vehicles if we fulfill the plans as the governments have been very ambitious. Well, how about AI? EV might not stick around. They might be changed by something else. It might be hydrogen, whatnot. AI is going to stick around, and it really consumes incredible amounts of energy. And this is just telling you, like, for instance, what the energy increase is going to be. For instance, they were taking NVIDIA as an example. If they really ramp up their production, and if that demand really is properly reflected in their stock price, the energy consumption is going to be tremendous. So the users of these of this hardware probably going to require up to 200% more electricity than we have to this point. This does not include the data centers and whatnot. But if you look at the whole picture, energy is not a solved problem here. Similar like the EV, because people just don't get it. People think that, you know, it's kind of virtual. They don't connect it with this incredible energy use like cars, but here with AI it is.
Yeah, I'm hearing that more and more.
Okay, let's take a micro look from the corporate side. I'm going to explain this graph in very quickly. This is the WINS framework that was actually pioneered by Harvard Business Review. It actually became overnight kind of like a mantra and a religion in the AI world, because the whole point that they're trying to simplify this journey for corporations, how urgent is for my firm to pay attention to Gen AI. These two quadrants are very telling and very well put together. So what they're trying to say here is the WINS framework stands for words, images, numbers, and sounds. That is the quintessential part of the generative AI. So what they're trying to say here is, what is your level of digitalization, and what percentage of cost is your company incurring for the WINS? Why do they do it like this? Because to actually implement generative AI, you have to have a certain level of digitalization. So what they're saying, if your company or sector has high level of digitalization, but also high cost of WINS, that means it's now. Meaning good news is if you move now, you'll do good. And if you don't move now, you'll go bankrupt. So like, for instance, that high digitalization, high WINS level is the upper right corner. They call the crucible. And then they actually broke it down by sector. It's saying what sector belongs where. So the sector that we are focusing a lot, that are pretty much right now under the limelight to perform or not to perform, are software, professional services, financial services, education, and entertainment. Next slide. There's also a factor of how much of these sectors and industries are going to be actually saving. What is the revenue potential? What is the cost saving potential? And what is the competition risk? So this graph kind of illustrates that, where each sector and industry stands in that. So the WINS factor, as Harvard Business reviewed it, overlaid with revenue, cost saving, and competition, is really the true and quintessential story of how companies are going to be measured. Are they performing or not? And industries and sectors in the market overall. Next. Okay, so this is putting it all together. I kind of expanded this beyond Harvard Business Review, more detailed sectors and industries, and we actually merged the wins quadrant placement you saw in the previous slide, along with revenue, cost, and competition. Of course, costs are always going to go down, but not necessarily revenues are going to go down. In some cases, like insurance, they're going to actually go down. Competition is probably the X factor here, because one thing that's not priced into this equation is that AI is going to dramatically lower the barriers of entry. And if that is true, that generally we're going to have much faster acceleration for the good or the bad, meaning companies are going to do good and bad much faster than we expected. And if you look at the competition factor, in most cases, it increases, which means in all cases, the barriers of entry are going to go down. I think that was the last slide. Yeah, that was the last slide. Now, just a little comment on the whole AI concept. If you follow the media, not just Bloomberg's of the world, whatnot, but a lot of these big investment bank research groups and whatnot, there's still a misunderstanding or at least simplification of AI. What is AI? How is it broken down? How is it affecting the marketplace? And then everything gets solved by throwing in a dozen of names they're publicly listed, and then, yeah, you just follow those names. It's a much more complex picture than I showed Tyson. I created a little kind of like a cheat sheet, or as the Brits would call it, a crib sheet, explaining how do you have to approach AI, like from breaking it down, analyzing it, categorizing it, to really understand. In other words, you have to create and understand the playing field before you can actually start creating portfolios, picking stocks, analyzing and whatnot. But that's something that was beyond the scope and time of this presentation.
Thank you, Mitch. We're going to move on to Richard Gula. Richard Gula.
Good morning. Good morning.
Needs no introduction, but I'll give one anyway. He worked with Dean LeBaron, Ned Johnson, and has been a professional, and he consults for a handful of Fidelity fund managers running probably 50, 150 billion, I don't know. But go ahead, tell us what you're seeing in your charts. XLF.
Well, in terms of looking at modern market structures from the viewpoint of somebody who's got a $5 or $10 billion portfolio, I always emphasize that there are certain core sectors in the market that have to be either in sync or acting favorably to be able to make sense of what's going on. In the heyday of Battery March, which was quite a long time, as Dean may or may not want to admit, we were largely blind to sector weights and allowed a very bottom-up approach to drive what a client portfolio would look like. And fast forwarding a mere 30 or 40 years, unfortunately, Dean, everybody now is very conscious of their sector weights and frequently are told to, I wouldn't say shadow, but to be conscious of not getting too far out of line, for fear of lagging the index. From the marketing department's view, that's a very bad thing. So I always begin with the look at the financials, and I'll look, and I go inside the ETFs first and score all the stocks, and I score them equal weight and then cap weight. And what you don't want to see is a big diversion there. What you like to see is that some of the smaller stocks are outperforming, because I think that we agreed from way back that small cap investors tend to know their stocks better than large cap investors do, and large cap like to kind of emphasize something to do with hold on here, something to do with a sort of a macro factor approach. And in the current, if you look at the XLF, Basically, it's underperformed the market on a long-term basis. I wouldn't say that it's got a big problem, but if you dig inside, JP Morgan holders are pretty happy, and Eastern Bank, which is the only bank left in the Boston area that of any size, is struggling. I don't have that chart in front of you, but it leads to a series of themes that show a kind of dispersion inside the market structure right now that's troubling for those who would like to index pure and simple. I would agree with Dean that the indexing the S&P right now is a good way to lead to some crying and gnashing of teeth, which, as we would say in the biblical sense. Can I have the next slide, please?
XLE, energy.
And energy is the second sector you have to take a look at, because not too long ago, the Brown University president divested all energy stocks from the portfolio. She then went on to leave and run a small college down in Texas, and then Harvard gave her an honorary degree last year. How the Brown endowment did, I'm not so sure. I'm guessing it didn't do very well, because if it had to match the S&P and energy stocks have acted as well as they have, that creates a real problem. The current energy environment, Tyson and I have talked at length about this. If you're going to go to basics and commodity kind of view, oil is down the list in terms of the most attractive, but not because it's unattractive. It's just that it's been moved kind of seriously up already, and is getting priced through mega stocks like Exxon. The political football element of energy is constant. But that said, that you would be long-term energy exposed here and maybe not admit it to your friends with an ESG bias. Next chart, please.
Real estate.
And here is where the problem seems to be developing. I've got a series of real estate charts that we'll go through a lot more quickly, but it ranges from the equivalent of the XLF in the commercial real estate world would be Blackstone, with symbol BX. Boston Properties would be sort of sitting down in the area of Eastern Bank relative to JP Morgan. And there's a link here that's fairly serious, and that is that there's growing data and writing and analysis that many of the regional banks in the low interest rate return environment did a lot of commercial real estate developing. You certainly can see it all over Boston. And I was at a presentation last week with a fellow who developed the international place, Don Shafaro, who said that the vacancy rate in the financial district right now is 36%. And he felt that that was short term. Of course, he owns a building in the middle of that I'm guessing has some occupancy problems. The real problem is that a lot of those mortgages and those loans are embedded in ETFs that have probably been used by a variety of asset allocators over the last several years. And those charts are uniformly troublesome, let's put it that way. And next chart, please. And that is, I can't, my charts are very small.
That says XLRE, which is real estate for the select.
Oh, no, I'm fine now. Yeah. The real estate, again, this is a CRE contagion problem of some kind. Nobody's really talking about it except to quote one-off transactions in commercial real estate. There's a poster named, I think, Ari Wald, but I could have the name wrong.
Yes.
On LinkedIn, who is just putting a lot of data up there and saying there's a real problem here. You're getting big markdowns, and whenever you have a transfer of property, and there's an actual behavioral data point as opposed to an opinion. Next chart.
He's the technician over at Oppenheimer.
odd.
XK, technology.
And technology, along with Mitch, what was interesting here is that, and you can't see it in the definition of this chart because it's monthly, but basically basically everybody exited on a volume basis out of the stocks that make up this ETF, which I'm pretty sure in NVIDIA, it's got a major weighting in here. And the rally that then occurred in October caught most investors off guard, and AI put an awful lot of buzz into this. But there's no problem here that I see. So next chart.
XLY, consumer discretionary.
Yes, and this is a very bifurcated area. I love the word bifurcated. Nobody can figure out how to apply it to finance, but I'm sure it'll be in the vernacular soon. If this is composed of a combination of, let's say, Lululemon and a variety of other retail, modern retailers that have done well online, especially, and Adidas and Under Armour and a number of global brands, Nike, that are having serious problems. And when the global stocks are problematic inside of the pool, it suggests that markets are efficient and very behaviorally accurate. That there's some kind of pending recessionary pressures. Let's put it that way. You don't want to get quoted calling for a recession because everyone will say you don't know what you're talking about. And I'm no expert on this. I can just say that this should be outperforming, not underperforming, given the amount of money and the global assets that have surged into the market in the last, say, 6 to 9 months. Just to give you some idea, an emerging market, if we have global flows going, one of the things that happens is that obscure ETFs do very well. Peru is up 70% and Poland's up 130 since the October lows. So there's plenty of money in the system right now. And if in fact were as studied as you'd like to think, and it knew that there was going to be rate cuts and a soft landing, this particular ETF should be doing much, much better. Next chart, please.
Schwab ETF.
Yeah, this is a Schwab. Schwab's going to use this in its asset allocation, and it's a REIT. I'm sure it's got a decent yield, but there's a liquidity problem here. They've been exiting this for quite a long time, which is why I put minus liquid there as the comment. Next chart.
This one says BX, Blackstone.
Yeah, so Blackstone is the biggie in this area, and it has the asset base, et cetera, to find a way to make the business go, and it's been under some pressure recently. If there's a real breakdown, if there's mass selling that comes in here, don't forget nobody can exit the sector completely anymore in most places. So you got to have exposure in real estate in some way. And this would be a very liquid and efficient way to do that. So there's a big watch here in my mind. And you don't want to see a failure because that could lead to a very serious downside in the broad averages because of factors we'll talk about at the very end. Next chart.
Yeah, I guess 08's a good example of that.
Yeah. And Boston Properties is the weak one here. Well, there was an article a while back that Boston Properties, Canadian pension plan. Dean will love this. Canadian pension plan decided they liked assets, so rather than do gold and oil from Canada, they did U.S. real estate, and they did direct investment through, I'm sure, a good manager that was highly recommended, and they put something like $30 million into a building in Park Avenue South below Grand Central Station. They recently transacted this, and Pension and Investment Age reported it. It wasn't a sort of a suspect source. But they sold it for $1 to Boston Properties because if they hadn't, they were on the hook for another 30 or $40 million. So these people aren't doing this because they needed a short-term loss or long-term loss against something in their portfolio. There's a big problem here. Next chart.
That's real estate mortgage trust. That's a Blackstone mortgage trust.
Yeah, and you see, this isn't quite as bad as Boston Properties, but the mortgage area is the area that I think is liable to blow up, or at least there seems to be a problem. Mortgages are used in tranches to then be loaned to they're bought then or accessed by hedge funds that then use it as collateral to go and do leverage investing. And where you get a margin call, as I understand it, is if the mortgages get marked down and the value of the tranche is marked down, and then if you have a little underperformance, you have to start selling something. So this is very much on the watch list of possible problems. Yeah. Next slide. Next chart.
MBB.
And MBB is the one that you could access in your amateur portfolio. Dean may
That's
not know.
MBS, that's a mortgage ETF.
Yes, it's a mortgage ETF. There's a website called the Boggleheads for Bogle. I'm saying it. I say Boggle because I don't think that they're as good as they think they are. Yeah. But the Boggleheads are based on the philosophy of famous Jack, that you could run a very low fee 3 or 4 stock portfolio and beat the market all the time. And if you believed in that, there's a couple of books out there that you can get on eBay or wherever you might want to look. That this would be a very popular exposure to the market, and I think that's where the problems are going to come in. The question is, will it be rescued if there is a problem? If there's a failure in here, and normally it's a counterparty, co-party kind of issue. That is something that's obscure enough so nobody cared until it happened. Next chart, please.
Okay, that is the XLB, the Select Materials Spider.
Yes, and the Select Materials is a long-term secular breakout. And the picture tells the story. And that is going to capture a broad base of companies that are related to core commodities or to something to do with basic industries. And so you basically have a barbell here between technology and commodity basics and energy, and then, as we'll see in the following charts, gold, silver, etc. Next chart, please.
Copper.
And copper, nice to see that copper is going with it because it's more of a economically sensitive, as opposed to whatever gold is a hedge against something going terribly wrong. This is more a hedge on maybe something going right. Next chart. And there's our long-term gold breakout. And gold is now at new highs. And the only thing that's a bit peculiar is that, as you'll see, and go to the next chart also, which is this is the sort of poor man's mean under $10 million portfolio access to gold. It's a smaller version of the GLD, both of which own physical gold. But you notice I circled the volume there. These ETFs are trading at extremely high volume levels. So this isn't central banks. This is regular somebodies out there putting a lot of money to work. Next chart.
That says Peru. And
yes, and so Peru, you would think Peru might go with copper, and sure enough, it has. But Peru is I would call it a second-tier emerging market. Don't forget, Brazil and China, I think, are still coded as emerging markets by MSCI. And Argentina where Barry March had some great experiences in terms of markets that went up when nobody believed they ever could. But from an equity fund to Latin America from long ago. Peru is doing just fine. It's lagging Poland, and that's in my alphabet portfolio, where you buy things based on your order in the alphabet. Inverse, of course, as a contrarian. So you start with the Z's. But all kidding aside, Peru is would be an interesting part of a contrarian portfolio right now. Next chart.
SCCO.
Yeah, and then there's always the folks that say I don't like ETFs and I don't like indexes, and I'm a really good stock picker. And if you're really good, you found your way to good old Southern copper, which I think used to be Southern Peru copper once upon a time. And that's about as good a chart as you can find in the market right now. Next chart.
That's
and there we go. So, in summary, the only thing I would say about wanting to get negative on the overall market, and this goes back to the very beginning of my career, I've become very aware of various indices and data sources. And the Institutional Broker Estimate Service, IBES, was founded about the time that I entered the business in the late 70s. It's still around, and it does forward earnings projections in a very disciplined way. And its current number is 252, and that's for a year out. The 20 times that would be 50/40, which is exactly where we are, more or less right now. I'd say exactly more or less. Obviously, we're fluctuating around that today. 22 times that is around 5,400, 5,500 in the S&P. And Ed Yardeni, who's been around a long time, is throwing out numbers like 6,000, but that's only 24 times that number. So that I'm not saying that this is guiding anybody, but I am saying that if you want to be bullish, there's people out there that have good reason to look at this kind of a number set and say, this is all noise, don't worry. I think if they do that, they're making the very big risk of not paying attention to something that's very core to this economy, which is something deep in the fixed income markets that isn't going to have an easy way out in an election year. Elizabeth Warren is not going to allow you to bail out an ETF or a firm that's got contagion problems with an ETF between now and the election. And so, summary, you're going to do the commodities, and the big part of your portfolio. Gold is plus, copper's plus, oil's plus zero, only because I'd like to see a pullback. And we didn't mention silver with this chart, but silver certainly would be there, being more in the industrial metal side of things. And lastly, homework, go look at charts of the Steel Dynamics, STLD, and the mid-cap index, because that's where a lot of these basic companies are hiding. And those are pretty interesting places to be right now. So thank you for the chance to talk today, Tyson. And
thank you, Richard. We got a couple of people who are smarter than me, so I'm going to start with them with some questions. Walter, what are you seeing? What are you thinking? And then we'll go to Dean LeBaron.
Sounds good. Hold on one second. I want to just bring something over to show you.
All right.
Tyson, may I go first? Because
yes, go ahead, Dean LeBaron. Go ahead.
I just has a buzz that I'm doing another room, but I want to thank you very much for being allowed to ding us. This has been a wonderful insight, and I'm here, of course, especially to be with my friend and former colleague Rich, and seeing it here is alive and well, so forth. And I must admit, seeing the sweep of the issues that could come up, and you did an extremely good job of setting that scene at the beginning. Scares the bejesus out of me if that's what's going on. Good people thinking about the tough issues. I quite agree. You and I, Tyson, are twins on inflation, and as I was somebody, my wife who came in and said I was due outside in a different part of the house. She said that I'm often wrong, but usually early. And on inflation, that was very much is the case. Now I must admit, I'll share a couple of secrets with you, and then I'll disappear. Secret number one: I've essentially been hiding from the stock market or bond market or all of this thing that we've been talking about for the last 10 or 15 years when I moved to Florida. I have since that time I have owned reasonable and a reasonable quantity of one stock, not American, and essentially not even traded as though publicly quoted, but that is immaterial. And that's the only thing I've owned, and I still own that, I must admit. There are a few other little tidbits
what
here,
is it?
but
What's the
it's
stock?
That's got to come out of that. I mean, I must admit, I'm looking at what's going on, and I expect about two years this will be a better time to come out of my hiding post. But we'll see what that is. It's not necessary. The other thing I've been doing is essentially working on my health. I figured that as I crossed 80 and I'm now at 90, the number that I was mostly concerned with was age and age related. I've been dealing with that with some success. Although I am sitting in a of all things, which I don't usually, a wheelchair, but it's not powered. And that's the best thing I can say about it. But I must admit, look at the sweep of things here, and I must admit, I spent a lot of time with Europeans, and they are getting a lot better in terms of some of the technical things that we were dealing with 20 and 30 years ago. People used to come to the United States to learn how to manage money. My suggestion for people in the United States is to look elsewhere to see what they've learned with emerging markets and heaven only knows what else. And European were there and European insights. So going out there, I'm not sure that the U.S. market is having the leadership, and we would go through a period, and others will do in the future what I've done in the past, which is to hide and then come out. Tyson, thank you very much. You did a wonderful job, and as I say, you scare the bejesus out of me. And Rich, good to see you. You've got all the vitality that you had way back when 30 years ago when we were spreading out all over the place, weren't we? I mean, making
Yes, indeed.
everything covered. And look what's happened to me. I've gone to the reverse. Only one, just one for about 15 years. Can you imagine it?
What is it? What is it?
Yeah, I know.
What you got to tell us?
I won't say. I'm sorry. No, because you'd blow the market up or down, whatever the case may be. I'm sorry. I'm bound by other associations to be absolutely quiet, and I have been quiet.
Can you tell us the type of industry?
No. No.
All right. Okay.
All right, but
we'll have to take you to the bar.
The nature is immaterial, but it's the reverse of diversification. Those of us who are institutional managers were emphasized diversification. Obviously, index funds was the maximum amount within diversification. Now, the last person I've heard was modifying the index fund concept was processing through AI 80,000 different security matches a day, and they do it about four times within 80,000, and his universe was 40,000, was 80,000. I'm sorry, and he could grind that with big data. I mean, it made what we were doing back then in terms of indexing and even the versions of them that followed. And one guy's coming for dinner tonight who's doing a version of that. I mean, it made us look very puny, but there are other people around the world, Japanese, Chinese as well, hidden that are doing great stuff.
I've got to jump in 2 minutes.
Go ahead, Walter. Thank you.
I have Tyson. I thank you very much, and Rich, thank you very much for your role. It's given me a warm heart.
Listen, Dean, I'm glad to see you're smiling, and don't go out racing in the wheelchair tonight.
I won't. No. And the battering march cannon is still in my driveway here at the beach house, guarding it for burglars not to come in. So it's still there. Thank you, Tyson. Good for you.
All right.
Thank you.
Be well, Dean. Be well, Dean.
Bye.
Okay, Tyson,
Go ahead.
the thing I wanted to show you is this. Has everyone or anyone heard of this?
No, very
Oh, I think I,
convenient warming.
A very convenient warming. This just came out in October. The gentleman is Gregory Whitestone. It's $17 at Amazon. I got it less than 24 hours after I learned about it. We all know, at least I think we all do, I know I do, that this whole stuff with, you know, intermittent electricity and what have you is completely for the birds. And, but what I didn't know, and what I should have known, and I've learned subsequently that some of my brighter friends did know, is that CO2 is not the enemy. That's why this is referred to as a very convenient warming. What's going on here is mind-bogglingly worse than one could have imagined. I'll just give one example and then jump off. I mean, in the stuff that you'll hear from all these nutso people, which there probably aren't that many of them, they just seem to be in many of the important places. You know, for every person that dies from increase in temperature, 10 people in cold areas live. I mean, just think about that for a second. There's just something the other day about how horrible it is. We've, you know, that 10 people out of something are going to be dying of heat, and there's no mention of dying of cold. That's just one of the things that actually, as you know, as we all know, the progress in agriculture since the 1800s, 1850s, even 1900s have been phenomenal. And it's one of the reasons that, you know, there's so many fewer people, and even to some extent land use in producing more food, and it's because of the increased carbon dioxide. So that's just something that I think, you know, I think is real important to fully understand. My portfolio, in part thanks to my discussions with Tyson earlier, is very heavily weighted to gold and to energy. And as a matter of fact, I've been adding to energy. You know, energy had a nice run and then it came down. And one of the stocks that Tyson put me in that he may not even still be in is Antero Resources. And today it's up some incredible amount. And I have the good fortune in my major portfolio to actually being up on the day because of the gold and the energy, even though oil is way down. So I agree heartily with that. I'm on board with copper. Some of the gold mining companies, one in specifically, has a good copper position. But I also think that, and I would agree that I take it back. I was about to say I'd agree that the Magnificent Seven are going to tank. You know, ideally they might, but one of the points that Mitch made was that actually, and those numbers that you saw that showed the PEs were 25 numbers, not 24 numbers. And that's the whole point, is that these things are still growing. So they may not get creamed to the extent we think. Tulsa, I don't understand. Ron Barron came out this morning saying it's fabulous. I don't get it because it doesn't make any sense to me. But the others may be right, but I don't own them. I don't know. Tyson, any question? Anything you want to say?
So what gold stocks do you own?
Well, I own
Just one or
AE.
two.
Pardon?
Just one or two.
I own maybe 3 or 4. The one that's got the copper is much more speculative. It's New Gold. It's all Canadian. And then Agnico Eagle is the best. And I recommend that one as well. And then I've got another one that's just speculative. And then I've got the PHYS, which is, as you may or may not know, you can actually turn in and get gold bars if you decide things are going to get hairy enough. And then the GLD, which I got involved in when gold was at 400. It took me until then to realize that gold is the only real money.
I agree with you. I think it's very interesting that gold has been taking off, but the stocks have lagged. But
yes, Yes, exactly. I think this is an opportunity.
Exactly, because what it means for some, or what it should mean is that the margins we know are going to expand because gold is up. So when they continue to sell, their margins are suddenly shooting up. If you're selling something at 2,400 as opposed to 18, you just had a 30% improvement to your gross margin. So
Right, but the thing, I don't know how many of you guys, oh gosh, I can't remember the name of it right now. Uh, high tech, what is it? The high tech, damn. Well, if nobody's saying anything, then you don't subscribe to it. Obviously, I do. It's a high tech strategist, and and he used to be a big tech guy, and he's now mostly in gold. And he has pointed out, as well as some of the other more knowledgeable players, that the interesting thing about this whole move is that normally gold, the price of gold is driven by the ETF, and it's driven by by us, primarily in America, but maybe the people that buy the GLD, stuff like that. This one has basically been completely done by all the national banks, Federal Reserve Bank here and what have you, and not even our own, but and also in China, huge, and India, where they're big. And so, according to these guys that follow it acutely, we haven't even seen the move in GLD and what have you that we'd expect, and then that will be followed by the miners. So I think that's good.
I agree. I would say that if you look at the moves in the 1970s, you had an 18-fold move. And then from the bottom around 2000, you had a 6-fold move. Those are enormous. So you've started to have a move here.
Well, right. I'm
but it,
trying to say, I think that's why. Yeah.
but it can go a lot further. And I listened to John Paulson, who made 5 billion, which is a admirable amount of money in gold in 2011. And he thinks that the run that you could have is quite considerable because there is just so much freaking money that has been printed and is out there. I just, it's hard for me to pick a top on it, but I think that, you know, you don't have to necessarily sell all the stocks and go into gold, but, certainly cutting back on real estate and banks and owning a lot more gold, whether it's physical or the miners, I think makes an awful lot of sense.
Can I just make a point
Yeah, go
there,
ahead,
Tyson?
Mitch.
I think I agree. It's a total perfect storm, but you're forgetting one thing. Let's start with the BRICS. There was a lot of talk, BRICS currency. It's not going to replace the dollar. It's going to be some toilet paper. Actually, we have a BRICS currency. It's working efficiently. It's called gold. That's what they're doing. And if this is the case, then India, China, and Russia have just started buying the gold, because how much gold China bought comparing to other countries is still minuscule. So, and that could also explain why you're going to see the fiat currencies, including the dollar, actually underperforming. So we're forgetting if you're talking historically, the highs in the 70s of 2,500, equivalent today, inflation adjusted, would be 10,000. I'm not saying it's getting there, but if you put all these storms together, it's almost impossible to see the gold stay here. And I think 5,000 is a realistic measure.
Well, Mitch, to follow up your point just briefly, the dollar is already a massive failure. Do any of you guys read Grant's Interest Rate Observer? Okay, on page 8 of the new one, they show the price of gold in dollars, or the price of and since 1914, the Federal Reserve Act was passed in 13, and in 14 it became effective, and the sole purpose was to preserve the purchasing power of the dollar back then. It wasn't until the 70s that they started getting into some touchy-feely crap. And right now, the current dollar is worth less than 1%, less than 1% of the 1914 dollar. So I mean, all the dollar is the best of a bad lot. None of them are any good, but the dollar's the best. Anyway, I appreciate the time, Tyson. I'm sorry I hadn't gotten back to you yet.
No, it's okay. We'll talk another time.
Yeah, stuff's been crazy, and I'm eager to listen to.
Tyson, just one other
Hi,
stress
guys.
point out there. The Nikkei and the yen are quietly creating some kind of chaos out there. And I realize everybody's looking at this as dollar strength rather than yen weakness. But there's got to be something going wrong inside the Japanese system, or there's some desire to let this go. And I'm no currency macro expert, but that's standing out just like the weakness inside that commercial real estate area. So this stuff's got to resolve.
Go ahead,
Yeah,
Mitch.
just to make a comment, I heard this theory, I read this theory, I don't know if I believe it, could be possible, that actually that was Janet Yellen's visit to Japan was about making sure Japan lets the yen slide because this is the best tool they have against the Chinese. Because a strong yen would be actually very beneficial for China. But basically, if the Japanese let the yen keep on sliding, it's going to be disaster for China. And I think there's a lot of substance to believe that this was a request by Yellen to the Japanese authorities. And if you look at how the yen reacted during and after her visit, there might be some merit there.
Fascinating.
Well, last observation, the contagion, Caterpillar is down 25% today. And that tells me that their mechanics of the market right now have a certain, it's either quite deliberate or very fragile. I'm not sure how to describe it, but that makes no sense in the world that Dean and I grew up in 40 years ago in value investing. Normally a stock down 25% of that quality, you'd buy the heck out of it. And I just looked at that chart and I wouldn't touch that chart for a long time. So there's something wrong in the system here that is not yet kind of been fleshed out.
Andreas?
Hi, guys. No question, actually. Thanks for the presentation. It was very good.
Okay, then we're going to wrap it up here. We've been going for just an hour and 10 minutes. Thank you very much, everyone. Have a
nice
day.
evening.
Thanks, Jason.
Bye, everyone.
Bye, Scott.
Thanks.
Bye.